Hello and welcome to this special webinar by ByteTree. Today we're talking about Global Trends Investor, which is our deep market intelligence service. The first thing to say is that this is not financial advice. This is educational and nothing should be taken as an investment recommendation. Today we're going to go through who we are, what Global Trends Investor is, how it works, and it's based around a couple of services that we run. The first is a free report on Mondays called GTI Top 200. Where we share our free insights based on the maybe 200 or 300 largest companies, anything over 40 billion in market cap, and the trend data that they are reflecting, that we're seeing. And then the premium service, the paid service that we offer, is a data spreadsheet with extensive data on 2,500 stocks across the world in every sector, which generates very interesting macro insights as well as stock-specific ideas and also areas and stocks to avoid as well. But I'm joined on the call by our founder and CIO, Charlie Morris, and Rashpal Sohan, CFA. So maybe you'd like to take a second just to introduce yourselves there.
Thanks, Kit. Yeah, I've been in the business for 27 years, which is too long. You'll notice that I've got the CISI qualification compared to Rashpal and Kit, who have both got the CFA, which is a far superior one. Back in the late 90s, we hadn't heard of the CFA, but it's what the UK did. Handing over to Rashpal.
Okay, so I had a strong background in finance, having worked with Robin Rathbones, the ECU group, but I wanted to improve my quantitative skills. So I decided to do a master's in data science, which was quite a leap having done the CFA. I was really basically sick of studies. But what it did teach me was invaluable skills in terms of programming, in terms of visualizing data, in terms of how to develop models, which was actually what was missing from the CFA curriculum. And that's actually what I bring to ByteTree and actually the work I'm doing in terms of analyzing data with Charlie and Kit. So I've actually helped create the dashboards, which help us better understand the stock trending, which countries are doing well, which regions, which sectors, where the opportunities, where the risks. And I'm always looking for ways to improve what we're doing week after week.
Brilliant. And that's what we're going to talk about today is all the improvements we've made. Global Trends launched earlier this year, and there's a lot that we're excited to show you. As for me, Kit, CFA, I'm the equity analyst. I joined here earlier this year and have loved learning about the global trends and building it out so far. So let's get into it. Charlie, you're going to take us away.
Global Trends. So it began in January 2025. That's this year, beginning of this year. And it's, I've been building models around stocks relative strength for 25 years. And, I finally gave up this year. I said, Rashpal, you can do this 10 times better than I can. And so we've just taken those relatively simple models and just really, really made them 10 times better. And it's a very, very exciting journey that we've been on. And it's, think of this as a market intelligence system for the global stock markets. And it's a broad coverage, and we get all these insights that come out of it, and we'll go through some of those. Hopefully next year, we're going to get this data set to move online. Not only have weekly data, but also daily data, and to be digestible in a number of different ways. And we're going to increase the size of the data set. So we really are becoming an AI company in that sense, with a mega data center somewhere behind ByteTree. Perhaps not that big, but nonetheless, we are moving into the 21st century at pace. So we're going to kick off with the example of Vale. And you've basically got a Brazilian stock, a big mining giant down there. And the local share price is in real is shown in black. Now, the real's fallen by 20% over the last decade against the US dollar. So we show the dollar share price of Vale in red. And there's a big difference there. When you've got a large data set and you've got different currencies, it's vital that you adjust everything in the same currency. It doesn't actually matter whether it's the dollar or the yen or anything else, but you just got to be consistent. Now I'm going to take that dollar price of Vale in blue and compare it to the world index in black. You can see it's outperformed over the years, starting at 100. The purple line gets to 145, and so it's beaten the world index by 45% over a 10-year period. Now, what we picked up on was not only the blue price was starting to improve, but the price relative to the market. And I think that's pretty interesting. Now, that's an analog observation. How do we make that digital? And I think that that's really what this is all about. And Rashpal, please explain how that's going to work.
Thank you, Charlie. So it's a very simple yet very powerful way of quantifying the strength of a trend developed by Charlie. So what we do is we do the scoring in local terms and relative terms of the price. How does it work? We score each stock on 5 factors. So each factor scores 1 point. The total can be 5 or 0, depending on how many factors score a point. The 5 factors are: is the price of the stock above the long-term moving average, which is defined as the 200-week moving average? If it is, it scores 1 point. Is the price above the short-term moving average, which we define as the 30-week moving average? If it does, it scores 1 point. If it's not, it's a 0. The next factor is the long-term moving average. Is that itself rising? So the slope is positive. If it is, it scores a point. If not, it's a 0. Is the short-term moving average, so the slope of the 30-week moving average, rising? If it is, it's 1. If it's not, it's 0. And then finally, we look at, did the price last touch the maximum, the 20-week maximum? If it did, it scores a point. That's a key factor, that even if the price touched it and it fell back, and it was the last touch with the maximum, it still scores a point. So in total, a stock can score 5, which means a very strong trend, or a 0, which means it's a very weak trend. And depending on the strength of the trend, between a 0 and a 5. So to show an example of how the scoring system is applied, look at the stock of Vale over the last 10 years. This is looking at the stock in local price terms, so not relative terms, right? What you notice is that the score oscillates over time as the price trended up, for example, between 2016 to 2021, and then oscillates again between 2021 onwards, right? So it never remains constant between 0 and 5. The scoring is shown at the bottom of the chart in blue. You noted that the score was around 5 between 2017 to 2018, and again around 5 between 2020 to 2021. If you remember, that was the inflationary up spike, right? Since then, the price has been trending lower and the scores has been falling, highlighting that the trend has been weakening. Because like I said, in our scoring system, a lower score means a weaker trend. Recently, if you look at 2025 price action, you notice the trend has improved. And at the same time, the score has also picked up, right? So it's reached about a 4. It's not a 5 yet because the 200-week moving average shown by the green line hasn't turned up yet. So it's strong, but not the strongest it's ever been. Now, if you look at that same chart on a relative basis, which is shown as the black line, and by the relative basis, I mean relative to the world index, right? Again, you can see that the score oscillates between 0 and 5. So it was very strong between 2016 to 2028, between 2016 to 2018. So scored between 0 and 4, and has been oscillating between that ever since, which has been performing in line with the world index till around 2023. You will notice that from 2023, the price action has been coming down, seen by the black line falling. And at the same time, the score has been dropping from 5 all the way down to 0 in 2024. Recently, again, it's picked up again, so it's around 2 to 3, and it's not the strongest it's ever been because, like I said, the moving averages on a relative basis have not picked up. So the green line is still trending down, and some of the other factors have not picked up. So you can see the difference in terms of local terms. It was around a 4. In terms of currency adjusted price relative score, it's around a 3. Yeah. So strong, but not the strongest it's ever been.
Thanks. What all this comes down to is, alpha versus beta. What do we mean by that? Well, beta is basically the market return. You can buy the world index for a few basis points in an ETF these days. So it's never been easier for a private investor or any other investor to have, global diversification, owning all the stocks in the world that matter. And as they change in each day, that's the value of corporate earth. Changing. So we can do that. So the only reason we're here as active investors is to beat it. And for that, we need alpha. So alpha is the difference between a stock return and the market return. And our models help identify that. And if you can build portfolios around alpha, then you'll do a good job. Now, it's not just one thing to identify it because the market doesn't have to be going up. The market could be going down. And so if something's going down less in a falling market, that is also alpha. In the same way that if it's beating a rising market, that is also alpha. But the point is, if you keep maintaining that alpha, your portfolio return will end up being whatever the market gave you in the long run, the beta, plus the alpha. And so I think this data set enables you to stay on top of where the alpha is. And people don't just turn up and offer you alpha on a plate. It's a highly sought of commodity. Investors really want it. And of course, the danger of seeking alpha is you might get it wrong. And we call that Zulu. And that is best avoided. Okay, so in our Monday report, the Global Trends Investor, we basically identify 5 groups of stocks. And the first are the leading trends. And these, in the good times, these are quite a stable list. There's obviously new stocks coming and going each week, but there tends to be quite a decent list that stands the test of time. And that's where, momentum investing is successful because trends go on for longer than people think. And we've identified the leading trends as a ByteTrend score of 5 in CAPR terms, and it made a CAPR high. In other words, it just touched the max line as well. So those are the strongest trends in the world, and we update on those each week. Now, recently we've added new trends, and that is that there are ByteTrend CAPR score of 5 for the first time in a while. And that's pretty interesting. That's a much shorter list, but it's definitely one that's worth staying on top of. And then on the bullish side, finally, we have the emerging trends. So they're not fives, they're less than fives. They could be good recovery stocks. Something that's been going down for a long time that turns up, and it's made a 30-week CAPR high. That's interesting. A lot of future big winners from value investing will come from that category. And then moving on to the bearish, we do the same thing in reverse. The weakening trends, they've made a CAPR low, so a 30-week relative low against the world index, but they're not in downtrends yet. For that, we have the bear trends. They've got a ByteTrend score of 0, they're going down, and they're making new lows. So I've got some examples here. Here's a leading trend, Goldfields from South Africa, in consolidation from 2020 to 2025, and then boom, breakout time, and we have a sustained CAPR score of 5. Investor, this was a new trend that we picked up in the week that we're recording this, and that's a Swedish conglomerate, which is basically a family office, and again, a period of consolidation and a new high. So that's quite interesting. And then FedEx been lagging the world for the last few years, along with other transport stocks and logistics stocks. You're giving us concern about the economy when the transport sector's slack. That means goods aren't going to market as quickly or in the same volume as they normally do. But the good news is that FedEx has made a 30-week relative high. It's not a long-term uptrend yet. We've still got the green moving average going down, but the other bit's good. It's a ByteTrend score of 3, so it's a medium-term uptrend with a long-term downtrend, and we call that an emerging trend. On the bear side, market darling Microsoft might surprise you that it's only just beaten the world index over the past 5 years, but that's now deteriorating. But the green line is still going up, and so it's not quite a bear trend yet. It may develop into that in time. We don't yet know. Finally, Digital Realty Trust, one of these data center companies in America, huge capital expenditure, and the negative vibe is now coming through for this sector, and it's made a 30-week relative low within a downtrend. So we highlight that as a bearish chart, and of course there are many more of these on the list.
So Rashmal, do you want to take us through the spreadsheet, the premium service that we offer, how it's built, how it's set up to be usable, visually friendly, the trends that people can see and where they can see them?
Absolutely. Thanks, Kit. So each week I output the data as a file. It's a CSV file, so it's quite large. It's over 100 megabytes. And because it's a CSV, it's quite messy. It's just raw data. The idea is to format it better so our viewers can basically digest the information easier and get insights much quicker, right? In the spreadsheet, you'll see there are 5 tabs. Each tab relates to a stock category, trend category. So we have all stocks, we have leading trends, we have emerging trends, we have weakening trends, and we have bear trends. What's shown on the screen is the all stocks sheet, which refers to all the stocks themselves, not categorizing the trends by any particular type, right? Each sheet basically shows qualitative and quantitative information, as you can see over here. On the left-hand side, you'll see the stock ticker, you can see the currency type, you can see the stock name. That's all the key identifiers of the stock. Which stock are we looking at, right? Next to it, you can see the different categories of the trend strength identifiers. So you have the CAPR score, which is the currency adjusted price relative score. You have the percent deviation from the moving average, which is the 30-week moving average in this case. You have other attributes which are used to categorize the different trend types. So for example, we look at the percent deviation either from the high or from the low, the CAPR high and the CAPR low. In this case, we're looking at the low, right? The other metrics we are also shown to help you understand the stock and the different attributes. So we're looking at the volatility of the stock. Is it a very volatile stock or is it a low volatility stock? We look at the size of the stock. So basically, is it a leader? Is it a Microsoft, or is it a small family kind of pop size stock? We have some attributes related to the sector, the vertical of the stock. So, which sector does it belong to? We have also created our own verticals, by the way. So these are industry groupings. There can be quite a number of industry groupings. So we've reduced these to make it easier and to categorize the stocks. Finally, we've also highlighted the geography of the stock and the country belongs to and the region. And these are all the key information which our readers will get week after week. It's very easy to download the stock and to peruse the different sheet tabs. Yeah. So each sheet tab has the different trend types, as I mentioned. If you're particularly interested in looking at what are your bearish trend stocks, look at the bearish trend category sheet. If you're interested in looking just specifically at leading trend stocks, looking at the leading trend category sheet. Now, from the scoring, we basically come up with insights which help us to navigate the macro environment to better understand what is happening in terms of the stock markets. One way we do this is we look at the aggregation of the scores in terms of countries, regions, and sectors. So what we've shown over here is the aggregation in terms of sectors and regions. So the regions are shown as rows, the sectors are shown as columns, and this itself looking at the local price action. So not the relative, but the stock price in terms of local local currency, effectively. The key figure to notice is the figure in the bottom right-hand corner, which is highlighted as 41%. So what this is showing us is that 41% of the stocks on our screen are meeting the criteria of a 5 in local terms. So that is not as strong as ever been, but 41% is not very bearish either. It's all in all, it's not a bad score. So we're still in a bull market. If you look at the same scoring in terms of relative price action, so this is the price versus the world index, the first thing that hits you is how much more faded this chart looks, right? The colors are less green, telling you that there are fewer stock which are basically meeting the criteria of a 5 in terms of relative price terms. So relative price terms is how we identify alpha. Alpha is those stocks which are basically outperforming the world index. The larger the number, the more alpha there is. The smaller the number, the less alpha there is. If you look at that figure and compare it to the slide I showed you earlier, the figure was 41%. It's now 15% in the bottom right-hand corner. So this goes back to the point which Charlie was talking about alpha versus beta earlier. It's a visual depiction of how much more difficult it is to identify alpha in the current environment. The bull market is not over, but outperforming this bull market is becoming much more challenging. If you look at the same visual now we're not looking at the strength, but looking at the weakness. So what we're showing you over here is the percentage of stocks which meet the criteria of a bear trend. So those which score a 0, and again, we're looking at it in local currency terms, not relative terms. If you look at the figure in the bottom right-hand corner, it's 13%, if my eyes are correct. So it's 13% is not very large. So it's telling you not many stocks meet the criteria of a bear trend. So again, going back to the key point that we're still in a bull market. Look at the same figure in terms of relative price action. Again, you can see it's much higher. So many more stocks are actually in a bear trend on a relative basis, so versus the world index. Again, making the point that alpha is much harder to come by. So this is a very simple way by which we identify risks and opportunities and to see where is the strength and where is the weakness and the overall environment. Is it bullish, bearish, and how easy is it to generate alpha or beta?
Thanks, Rashpal. So here's a time series on that data and starting in local currency. There are quite a lot of stocks going up, and that's why we're in a bull market. That's in blue. It is contracting ever so slightly at the moment, but the number of bear trends is also slightly rising. So it's probably an indication the market is softening a bit, but still very much so the case that we've got a large number of stocks that are going up, and that's bullish. Now, taking that same data set and looking at in CAPR, the alpha opportunity is quite light. There are not many stocks outperforming. There were more in the middle of the year and fewer underperformers, but that's now changed. So it's really telling you quite categorically that alpha generation is quite hard at the current time because it's such a narrow opportunity set.
One of the simple ways we use to identify risks and opportunities is by looking at which are the strongest trending countries, regions, sectors, industries, etc. Right? The way we do this is we basically aggregate the scores, average them across countries, sectors, and regions. In this chart, what you're seeing is the aggregation across the different countries. On the left-hand side, we've shown a simple bar chart which shows the average by country. What you will notice is that there's a wide divergence between countries in terms of the average trend score, right? So this is shown in CAPR terms, so basically price relative. You will notice at the very top, we have Italy, Spain, South Korea, and Mexico. And Charlie and Kit write about this week after week. At the very bottom, we have countries like Norway, so Australia, the commodity-related countries, Belgium, India. At a glance, it's very easy to see from the scoring which countries are strong and which countries are weak. The way we highlight the strong and the weak countries is not just their ranking, but color coding them. What we do is we calculate the average. Those above the average are color coded in blue, as shown on the left-hand side, and those below the average are shown in red. We also monitor the trend of these over time to see are things getting better or weaker. Italy could be, for example, at the top, but it doesn't necessarily mean it's trending upwards, as you can see in the trend chart shown on the small multiple charts on the right-hand side. So for nearly all the countries, you can see the trend is either flat or trending lower. Italy, Spain, which are the top two countries. If you look at the very bottom, Norway, Australia, Belgium, India, the trends are decisively bearish. Again, going out to the point which Charlie was making that alpha is getting much harder to come by, even at a country level. There are very few countries which are outperforming, and even those which are not doing on an upward trajectory. If you look at the same in terms of sectors, so again, the same aggregation down by sector, you will see the top strongest trending sectors are financial services, industrials, energy, utilities. It's strange to see utilities at the top because utilities is actually more of a defensive sector. So you tend to see it outperform when other defenses are outperforming, so like consumer staples, healthcare, but it is what it is. And that's what the macro environment is telling us, right? At the very bottom, you have very bearish sectors, for example, consumer cyclicals, real estate, consumer defensives, etc. Again, look at the trend charts. You can see financial services, despite being the top outperforming sector on a relative basis, it's been trending lower for the last couple of months since around July, right? There are very few sectors you can identify here which are trending upwards. So if you're looking to outperform the markets, it's going to be much more challenging. What we've also done is we've decided to go one extra level, not just look at sectors, but also look at industries. Now, if we just look at the raw industries produced by the providers, there are just too many to categorize. So what we have done is we've created our own categories in-house to make it easier to digest the information. Those categories are shown in this chart over here. You can read them on the left-hand chart. So at the very top, we have diversified holdings, metals and mining, which is clearly gold and other related copper, etc. We have bank and lending, right, related to the financial services, which is doing well in the sector level. At the very bottom, we have manufacturing and composite, I believe, food and beverage commodities, and then we have chemicals and commodities, right? Again, if you look at this, you will not see many trends trending upwards, not many industries trending upwards. There are very few. Even for the very strongest ones, diversified holdings, metals and mining, the only one or two or a handful I can actually identify as trending upwards. The vast majority are trending down. So you can see it in country level, you can see it in sector level, you can see it in industry level. The trends in terms of relative outperformance is generally south. Now, this is actually one of our most useful charts, which we closely analyze week after week. What it does is it disaggregates the industry groupings with the regions. So what it allows us to see in one glance is in which region, which industries are outperforming. That's highlighted by the deep blue colors. At the very other end, we have the deep red colors, which highlights the very weakest trends on a relative basis. So you can see, for example, environmental and infrastructure in Asia stands out at 3.8, right? There are not very many cells highlighted in under Asia, which are standing out. Same with America. America is very shaded. There's only metals and mining which stands out. And in Europe, you have a few at the very top, diversified holdings, metals and mining, bank and lending, right? Just using this, Kit and Charlie then can go and look for opportunities at the stock level in each country, region, and industry using this simple visualization.
Thanks, Rashpal. So clearly the current market is one that alpha seekers need to pick stocks. They can't rely on countries and sectors like they can sometimes in quite the same way. But we break out those groups here, our leading and our emerging and our weakening and bear trends, and see how they're doing. Now, starting with local currency, on the left-hand side, quite a lot of leading trends, some emerging trends, a large number of weakening, and fewer bear trends that have shown up this week with the criteria that we described earlier, but this time in local currency. I think, we can see how that's worked over history, pretty stable on the blue line with a dip in leading trends during the Trump tariff crash of April 2025. On the emerging trends, quite steady in local currency. Lots and lots of weakening trends during April, which then settled down in the market recovery, but that's now starting to build again. And that same pattern is repeated for the bear trends. Now let's look at that in terms of relative, in terms of alpha, in terms of kappa, and the whole thing just comes into reverse, basically. And so you had more leading trends during the crash with defensive stocks held up. Ironic, one of those things you've got to get your head around in this set. But we haven't had that many leading trends recently, nor the emerging trends. But we have started to see a growing number. We showed you that earlier. That the many stocks are not many stocks are going down, but many stocks are underperforming the market. And so in the rotation that we've identified in recent months, away from tech towards value, that really is borne out by those lower charts with more weakening and bear trends. And let's have a look at how those sectors have done. Now, apologies, this is a bit faint, so you'll just have to hear me out here. But the best performing group of stocks has been weakening trends, which may surprise you. Now, if I showed you this over 20 years, that wouldn't always be the case. Weakening trends would be a weak group, but it is a feature of the post-April crash. Now, why? Because in April, the market became heavily oversold. And so guess what? In a momentum crash that follows a market correction, you get a reversal of the momentum effect, and the most oversold stocks did very well, but not for very long. Into May and June, they did very well, and they haven't done much in recent weeks. The leaders, the blue trends, actually didn't fall much in April and have been pretty steady over time as they've built good performance. Then we've got the red line, which is the bear trends. They went down the most in the correction, which is no great surprise. They also had a good recovery, and that has slowed down. Now, if the bear trends were going down, then that we would be on bear market alert. But they're not. They're stable. So even the worst stocks aren't going down much, which is very positive for the market overall. And then finally, the worst performing group currently is the emerging trends. And so, the new trends are overbought by definition. They're not actually in trends. They're trying to be in uptrends, but they're overbought by the time the signal is generated. And so they actually haven't performed very well. But don't forget that within that group, some of the greatest winners reside. That's where value investors are going to find their treasure for the future. So I think it's quite important to understand that. Now, just moving on to 3 practical examples of how we've applied this here at ByteTree. My ByteTree multi-asset investor, which is now soon to be 10 years old. One of the stocks we picked up was a Malaysian ETF. Why? Obviously, we're talking about trend here, but trend is our dear generation. We also do deep dive into fundamentals once we've found some good ideas. But Malaysia's a great country, and it's been outperforming the world over the 21st century, and so we're slightly ahead. But it has had a pretty miserable 10-year period, as have many emerging markets. The price chart in local currency hasn't done much in that period. Actually, the Malaysian rial has been a pretty good currency, but in kappa terms, it's just massively underperformed and started to show some strength. And that triggered me to look at Malaysia in much more detail. And, I thought it was a great opportunity. I think that in this day and age, to try and find good emerging nations makes a lot of sense to me. Kit, do you want to do the quality idea?
Yeah, so Denon is a company that we knew and really liked. It has a phenomenal track record over many decades. It's a market leader in an industry that we see having, potentially centuries of growth ahead of it. It's a staple in so many households across the world. The management team is high quality. The financial performance is excellent. We knew all of that, but it had a pretty difficult time, with the cost inflation of 2022, 23. You can see that in the local price. It was struggling, and in Qatar, the underperformance relative to the world index in dollars is also very clear. But we picked up during 2025 that it had started to outperform. The turnaround they'd put in 2024 had started to bear fruit, and the market was starting to reward it for that. So we combined a sort of highly fundamental qualitative analysis of the company with a recognition that the market was starting to recognize that and that it was starting to deliver outperformance.
Yeah, thanks, kid. I mean, Danone's always been a good company, and I'm sure it always will be. That's why we call it quality, but it doesn't necessarily always have to be beating the market. So we are trying to, in quality, to find the best companies, yeah, which are relevant in their time. And then finally, venture. Quality is obviously the most resilient, least risky equity service we have, and venture is the opposite of that. It's the most risky. We embrace volatile stocks here. And RGX is a biotech stock. ByteTree, this data, this global trends data set, picked up the strength in healthcare, biotech, life sciences, in the autumn, and what a fabulous signal it was. And RGX is a very high growth company based in Belgium, or listed in Belgium anyway. And you can see that the stock price chart in euros is approximately the same as the CAPR chart. And the reason they look so similar is because they're a very high alpha situation. And high alpha stocks, they kind of ignore the world index, saying, well, that thing doesn't go anywhere compared to what we do. And so the alpha chart starts to reflect the share price itself. But nonetheless, a very good signal we've picked up on. And so, this data set was useful in two ways. One, identifying, look towards healthcare, which had been in the doghouse for quite a long time, and also picking individual stocks, which has happened across all of our services. So, what is it all about? Market intelligence, yes, some of that's stock picking, but it's really a deep understanding of the market. It's a complex beast, thousands of stocks out there. What the hell are they all doing? Um, and and this really just picks out the salient points you need to know. An opportunity, and what's a danger? And and I'd love to be able to know what the future of the stock market looks like, but we don't have that privilege. The second best bet is to study it carefully and get the insights as you can. But it's been a really interesting year, hasn't it, guys? 2025, we kick off global trends. It's a major step forward for ByteTree generally. And first thing, I'd like to thank you very much, Kit, for starting early on Mondays, and Rashpal, even more importantly, generating the data set on Saturdays. I used to, in my school days, have Sunday night blues when I didn't look forward to Monday. But these days, with the data set, I do look forward to Mondays. I find it very, very exciting to stay ahead. And now, Kit, starting with you, I mean, you're a sort of hand up fundamental investment guy, CFA qualified, the qualitative history degree. You love the sort of to kick the tires of a company and assess its fundamentals. And you're a bit of a skeptic when I dragged you into this trend following nonsense earlier this year. How do you feel about it now?
Yeah, I mean, probably more than a skeptic, and it has been a great learning curve over the course of the year, partly for me, and then also in terms of the developments that have gone on with global trends, the things that we've built, the things that we've improved. I suppose I sort of put technical analysis all in one bucket of sort of magic charts on Twitter, but I really had never understood the powerful force that momentum is, the trend following, the whole world of trend following with an investment, and the fact that it's an enhancement, it's additive to a fundamental strategy, be that quality, be that value, which is not that it's a replacement for those things where you just ignore whether a company is good or not, whether it's cheap or not. But in fact, you layer momentum, you layer trend following on top of that. And we call it market intelligence because there's not always the same answer. It's just a case of, as you say, looking around at the constantly shifting winds and waves of the markets and saying, okay, it's interesting over there, it's interesting over here. This is working now, not yesterday, but tomorrow. And so, yeah, sort of building that into the fundamental process rather than replacing it, I think is what I've found so interesting through the course of the year.
And Rashpal, I mean, you're in Nairobi, and
Yep.
somehow the data magically gets created there and lands here. I don't know, through a satellite
Absolutely.
or something. And you've been doing this for a very long time. We met 25 years ago when you started working for Robin, and you just got the bug, haven't you? I mean, you never really described yourself as a technical analyst, have you? But you know more about it than anyone else, I'd say.
Absolutely. Charlie, it's been quite a journey to get here. I will say the work I'm doing with you is levels up from what I was doing with Robin in terms of the complexity, in terms of the volume of data we're handling. I don't think it ever got to this level. Maybe it would rank the FTSE All-Share, maybe the S&P 500, but we never did like 3,000 stocks with this level of dashboards, insights, etc. So it's been an eye-opener. I've enjoyed the skill growth. I've enjoyed what we're doing. I really enjoy the discipline week after week. Running the data, of course, there's a bit of trepidation week after week. I hope something doesn't go wrong in my code and I have to send Charlie an email to say, I'm sorry, something's gone wrong this week. But luckily, nothing's gone wrong so far. And Mark is working behind the scenes with us to make this more robust for next year. So it'll all be automated, right? I enjoy the insights we generated. Some weeks, nothing changes at all. And it tells you markets are like that, right? It doesn't always mean there's something interesting or a signal. But some weeks you'll notice something very interesting. Like I highlighted for you on the chats, on our Slack channel this week, a few of the very interesting insights. I really enjoy the systematic process. The way my mind works is I like a discipline. I like things, when there's a formula behind it. I love the scoring system. I love that you can quantify trends. You can see what's strong, what's weak. You don't have to agree with everything, but it brings up to your radar. It makes you ask questions. If you're a fundamental analyst like Kit is, to some extent, even I am because I've done the same qualifications, but it allows you to basically look at things differently, right? I also like the evolution week after week, Charlie. You've seen we introduced new charts. Last week we were trying some new of those charts of the radial charts to look at things all in the 360 view. Every now and then we ask ourselves, is there a better way of showing something? You recently introduced the matrix, the scorings of the fives and the zeros. So you can see we're not just happy to be where we are. We're looking to basically up the game, to look to do things better and find better ways of analyzing the data, right? What I do worry is that we're hitting the limits of big data. At one point, I was trying to analyze this beyond 60 weeks, and I ran out of rows in Excel. So they teach you about big data in university, but it's not till you've run out of a spreadsheet that you begin to realize, now I understand what they mean by big data. You can't use Excel. You've got to find another tool to do it, right? So that's actually when I started to have conversations with Mark. Mark is our genius in this, in terms of the infrastructure. So he's doing a lot of work to make this easier and to find tools by which we can analyze years of data. Just think about it. 3,000 stocks. We have 252 days basically of each stock. Look at the number of columns we have for each stock, the percent deviation, the sector classifications, etc. So you can imagine how much data we're collating. If someone tried to do this at home, I wouldn't recommend it. You might burn your fingers. But whatever it is, I believe we're adding a lot of value and we can only get better and better with time.
Yeah, absolutely. And hopefully we're going to make this data set daily. I mean, given the choice of daily or weekly, I'd always choose weekly because I think that it just reduces so much of the noise that's out there in markets. It gets you the big stuff. Yeah, the signals are a little bit slower, but they're probably more reliable. And I think that people are far too short term when they try and do technical analysis. You want to sit back and let these things happen. But we will be adding daily, I hope, next year, whole thing on screen with different ways to digest the information. Not quite sure where it's going to go, but that's the exciting thing about it. And it's hilarious that spreadsheets are massive things these days, and you've run out of spreadsheet. As we go into the cloud and start to do super duper magic, then we start the back testing and we start analyzing strategies. And so, this is the tip of the iceberg of where this project's going. And it certainly keeps me extremely excited by what's happening. And so, fabulous. Well done, guys. And let's look forward to, great progress in 2026.
I'd encourage our readers to share their insights. If they think there's something they'd like to see, if they think there's another angle to look at something, I would really encourage them to write in, to share their ideas, to share their views. Because our evolution is not just based on what we do internally, it's also based on the feedback we get from our readers. And sometimes our best ideas come from there.
Absolutely. Point well made. We love feedback. So if you do like what we're doing, let us know. And if you don't like what we're doing, let us know. Or just don't read it. But those who do like it, then please spread the good word.
Yeah, indeed. And for me, one final word is just that, you read financial media and it seems to all center around 10 companies in America. But what Global Trends, I think, does so well, as Rashpal highlighted, with the 25 industries, with every single country as highlight, alpha is being generated all over the world in all different sectors, not just tech in America. And this is a tool that allows you to go and find it. So yeah, dive in, test out. There's a free spreadsheet in the GTI 200 that goes out on Mondays. So you can see if you like that for finding ideas in the 200 biggest companies in the world. But yeah, give it a read. Hope you enjoyed the webinar today. Thank you very much, Charlie. Thank you, Rashpal, for talking us through it all. Well done to you both on building such a fantastic tool. And here's to a great 2026.
Thank you. Thank you, Kit. Thank you, Charlie.
Thank you.
Thank you.